20% down on a $415,000 house is $83,000. 5% down is $20,750. The difference is $62,250. And that money doesn't get consumed, it gets moved. It leaves an account that has historically compounded near 10% a year and enters an asset compounding closer to 4, where you can't reach it without a lender's permission. So we're going to follow that exact $62,250 for 15 years. 2 columns, same house, same closing date, same total housing budget. One buyer puts 5% down and pays private mortgage insurance. The other puts 20% down and pays none. At the end, you get a net worth number for each, and the gap between them is smaller than almost anyone repeating the 20% rule would guess. Dryly. It also changes sign depending on what week you locked your rate. That part surprised me, and it's why I'm putting every assumption on screen before I touch the math. The house is $415,000, which is roughly the national median for existing homes and sits inside the range Chicago and Atlanta metro medians have been trading in through this year. Georgia's multiple listing service put the Atlanta metro median around $408,000 in June. 30-year fixed rate, 6.67%. That's Freddie Mac's weekly survey average for the week of August 13th, 2026. House appreciation is modeled at 3.5% a year. I want to be honest about that one. It's a long-run planning average, and it is well above what the market is actually doing right now. First American's data showed annual house price growth around 1% in July, the third straight month near 1. I'm using 3.5 anyway, and here's the trick. Both buyers own the identical house, so appreciation cancels between the columns. Whatever the house does, it does to both of them equally, which means the entire result comes from the loan, the insurance, and where the leftover cash sleeps. 2 loans, then. $332,000 for the 20% buyer. $394,250 for the 5% buyer plus mortgage insurance. Not a vague penalty, a quote. The Urban Institute's housing finance tables put private mortgage insurance somewhere between 0.46% and 1.5% of the original loan per year, priced off your credit score. At 740 and above, you're looking at about 0.58%. On a $394,250 loan, that's roughly $2,287 a year, about $191 a month. And that premium buys you nothing. It insures the lender against your default. You pay it, they're the beneficiary, and the only thing it purchases for you is access to the house years before you'd otherwise have the cash. Matter of fact, that's a real product. It's not a scam. It's also not yours. Which raises the only question that decides whether it matters. How long do you pay it? Here's where most explanations get it wrong, and the error costs actual money. The common line is that mortgage insurance falls off automatically at 80% loan to value. It does not. Under the Federal Homeowners Protection Act, at 80% of the original value, you have the right to request cancellation in writing with a clean payment history and no second lien behind it. Automatic termination doesn't arrive until the balance is first scheduled to hit 78% of original value. On this specific loan, at 6.67%, I ran the amortization. The balance crosses 80% of the purchase price around month 125. It reaches 78% around month 137, 12 months apart. 12 months of $191 is about $2,300. And the only thing standing between you and that money is a letter you write in year 11. Different product, different rule. If this were an FHA loan with a small down payment, that insurance mostly runs for the life of the loan and no letter fixes it. Conventional financing with 5% down has an exit date. Put it in the calendar the day you close. So the total insurance bill is finite. Roughly 124 payments at $191, about $23,600 over 10.5 years. That's the drag. And as of this tax year, it's smaller than that. The One Big Beautiful Bill Act, signed July 4th, 2025, permanently restored the treatment of mortgage insurance premiums as qualified residence interest, starting with tax year 2026. If you itemize, that premium is deductible again. At a 22% marginal rate, your $191 behaves more like $150. The same law raised the state and local tax cap to $40,000, which pushes a lot of households back into itemizing who had stopped bothering. Two conditions though. You have to itemize, and the deduction phases out above $100,000 of adjusted gross income and disappears entirely at $109,000. Plenty of people watching this earn past that. So I'm going to hold that benefit out of the main scorecard and bring it back at the end as a separate credit. Because for some of you, it's worth real money, and for others, it's worth nothing. Now, the other side. What does the $62,250 do if it never goes into the house? 15 years in a low-cost fund tracking large American companies. Long-run nominal total return on that index has run about 10.1% a year across the full history since the late 20s. And after a 3 basis point expense ratio, call it 10.06. $62,250 becomes about $262,000. Slows down, $262,000. From a decision you make once at a closing table in an afternoon. And if we stop the video there, it would be wrong. Because that number is a single lane, and single lanes lie. Run the same 15 years through a poor window. Instead, one of the weakest modern 15-year stretches compounded around 3.67% nominal, and your $62,000 becomes about $100. $7,000. Run it through the 2010 to 2024 stretch at roughly 13.87%, and it becomes about $437,000. Same starting cash. A $330,000 spread in outcomes, and nobody gets to pick their lane in advance. The bear lane is the one that decides this video, and we'll come back to it. By the way, if you like housing math with the vanity numbers taken out, clicking subscribe genuinely helps, thanks to everyone who does. Because there's a flow I haven't put on the board yet, and it's the one that breaks the whole comparison. Principal and interest at 6.67%, about $2,536 a month for the 5% buyer. So about $2,136 for the 20% buyer. That's $400 of difference. Add the insurance premium, and the 5% household is spending roughly $591 more every month on identical shelter. Which means the 20% buyer, if the housing budget is held identical, and it should be, that's the whole premise, has $591 a month that the other household does not, quietly. So where does that go? Into the same index fund. Same rate, same fee, same 15 years. And the standard version of this comparison never does this. It lets the small down payment buyer invest their leftover lump sum and quietly assumes the other household spends its monthly surplus on nothing in particular. Run it properly. $591 a month for 124 months. And then, because the insurance premium terminates and the gap narrows to $400, about $400 a month for the remaining 56. That curve bends in month 125, exactly where the cancellation letter goes out. Total about $223,000. So the $262,000 lead is not a lead, it's $39,000. And we still haven't priced the mortgages. 15 years in, both households own a house modeled at about $695,000. The 5% buyer still owes about $288,000. The 20% buyer owes about $242,000. $45,500 more equity in the 20% column. Not from appreciation, from having borrowed less and amortized a smaller balance. Line them up. 5% path, about $407,000 of home equity, $262,000 in the brokerage. 20% path, about $453,000 of home equity, $223,000 in the brokerage. The 20% column wins by roughly $6,500, with restrained disbelief, $6,500, on a 15-year, $670,000 balance sheet. That's about 1%. Add back the insurance deduction if you qualify for it, and the sign flips the other way by about the same amount. That smallness is the finding, and a difference that thin doesn't survive contact with anything. It also hides something the scorecard can't show. Those two households have the same net worth and very different lives. The 20% buyer spent $62,250 that now lives inside Drywall. Getting at it requires a home equity line, a cash-out refinance, or a sale, and every one of those is priced by whoever is lending that month at a rate you don't control on a timeline you don't control. 4 different things get confused constantly here. shelter you consume, cash you can spend, equity you can't spend without borrowing, and investment return. This scorecard measures one of them. The 5% household carries $62,000 of it in a form you can sell on a Tuesday. That's not free, it's volatile, and it's taxable when you sell, but it exists. Which brings me to the part I find mildly irritating. Always put 20% down is not a finding. It's a rule of thumb from a period when mortgage rates and expected equity returns were nowhere near this close together. Repeated by people who have never once run the monthly surplus forward. At certain rates, it's right. It happens to be roughly right this week. That's not the same as being a rule. Here's the number that actually decides it. Rerun the entire scorecard at 6% instead of 6.67. That's not hypothetical. Freddie Mac's survey printed 6.00 for the week of March 5th this year, after a 5.98 reading on February 26th, the first sub-6 print in about 3.5 years. At 6%, the payment gap shrinks to about $564 a month, insurance included. The premium cancels earlier, around month 117, because a lower rate amortizes principal faster. The 20% buyer's invested surplus falls to about $210,000, while the 5% buyer's lump sum is untouched at $262,000. It doesn't care what your mortgage rate is. Result: the 5% column wins by about $7,500. Same house, same insurance quote, same index return. The winner reverses because of 67 basis points. Run it across the range, and the break-even sits near 6.3%. Above that, borrowing less wins. Below it, keeping the cash wins. Slower. And your rate isn't a market opinion. It's a printed number on a lock confirmation. Compare it to 6.3 and you have your answer, provided one condition holds. That $223,000 in the 20% column is not an asset. It's a behavior. It requires 180 consecutive monthly transfers, starting the month after closing, through a job change, a furnace, and 2 market drawdowns that make you want to stop. Switch that engine off. Assume the $591 a month goes where surplus money usually goes. A nicer car payment, a kitchen, nothing memorable. And the 5% path wins by about $216,000. No insurance premium closes that. No rate difference closes that. It is larger than every other variable in this video combined, and it is not determined at the closing table. It's determined by whether a standing transfer exists. Second thing, and thank you to everyone clicking subscribe. It does help the channel more than you'd think. So here's the decision, and it's 5 questions about you, not about housing. What rate did you actually get quoted? Above roughly 6.3, the extra down payment earns its keep. Below it, it doesn't. Does the monthly surplus have a standing automatic transfer behind it or an intention? If it's an intention, put the smaller amount down and keep the cash. Do you know your own 80% month mine? Came out around month 125 at this rate. And is the cancellation letter in your calendar? Because waiting for automatic termination costs about $2,300. Is your adjusted gross income under $109,000? Because that's whether the insurance deduction is real for you or theoretical. And how much liquidity do you want on your side of the closing table, knowing the alternative is borrowing your own equity back at whatever rate exists that year? $62,250 moved, $262,000 in one column, $223,000 in the other, $45,000 of extra equity to settle it, and 15 years later, the 2 households are within about 1% of each other. At 6.67%, with the surplus genuinely invested, 20% down finishes marginally ahead by a margin thin enough to sit inside the model's own error bars. At March's 6%, 5% down finishes ahead. And for anyone who won't run the monthly transfer, 5% down wins by roughly $216,000, which is not close. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. So choose the down payment on liquidity and the insurance calendar. Choose your net worth on the monthly outflow. The $83,000 was never the lever.